Have you ever sat there, watching a trade go against you, feeling that knot in your stomach tighten? You see the price getting closer and closer to your stop loss. Your plan, the one you so carefully created, tells you exactly what to do. Accept the small loss and move on. But then, a thought creeps in. Maybe it'll turn around. Just a little more room. I can't be wrong on this one. We're going to follow the story of a trader. Let's call him Alex. His story might feel very familiar. Alex is watching a losing trade. His cursor hovers over the stop-loss order. Instead of letting it trigger, he clicks, drags it down just a few pips. He tells himself it's a strategic adjustment. He's just giving the trade more room to breathe. The market is just a bit noisy today, but what's really happening in his mind? This isn't a strategic decision. It's an emotional one. He's not trying to manage the trade. He's trying to avoid the feeling of being wrong. In that moment, the pain of admitting a mistake feels far worse than the risk of a bigger financial loss. His ego has taken the driver's seat. It's whispering that being right is what matters most, that his analysis has asterisk to be correct. For the ego, protecting itself feels safer than following a rule. A rule is just a line on a chart. But being wrong feels like a personal failure. And for a moment, it looks like it worked. The price pulls back from his new stop loss, moving closer to his entry. Relief washes over him. See? I knew it, he thinks. I was right to move it. This brief moment of relief is incredibly dangerous. It reinforces the bad habit. It teaches his brain that breaking rules leads to reward. He's not learning to be a better trader. He's learning to be a better gambler, hoping luck will prove him right. But the market doesn't care about his ego. The small pullback was just a pause. The price reverses again and starts falling, this time with more momentum. It blows past his original stop loss, past his adjusted one, and the loss grows larger and larger. His hope turns to frustration, then to a quiet, simmering anger. He feels stuck. The loss is now too big to take. Taking it would mean admitting he was wrong not once, but twice. First on the trade itself, and second on moving the stop. Eventually, the pain becomes unbearable. He finally closes the trade, taking a loss that's 3 or 4 times bigger than what his plan allowed. He stares at the screen, not at the chart, but at the red number in his account balance. He feels a wave of embarrassment, even though no one else is in the room. He's angry at the market, but mostly, he's angry at himself. This isn't just a financial loss. It feels like a reflection of his intelligence, his worth as a trader. What would a professional do in this situation? A professional trader understands that being wrong is a part of the business. They don't see a stop loss as a sign of failure. They see it as a business expense, a necessary cost of finding profitable opportunities. When a trade hits their stop, they don't move it. They accept Italiano. They know their job isn't to be right on every single trade. Their job is to execute their tested strategy flawlessly over the long run. They trust their plan more than their feelings in the moment. Later that day, Alex knows he should review the trade. He should open his journal, document what happened, and analyze his mistake. But he doesn't. He quickly closes the trading platform. The thought of looking at that trade again, of reliving that feeling of failure, is just too painful. He avoids it. He'll look at it tomorrow, or maybe next week. This avoidance is the final link in a destructive chain. By not reviewing the painful trade, he guarantees he won't learn from it. His ego, still trying to protect him from the pain of being wrong, prevents him from doing the one thing that could actually help him improve. He's trapped in a loop. His ego causes a bad decision. The bad decision causes pain, and the desire to avoid that pain prevents him from fixing the root cause. A professional trader, on the other hand, considers the post-trade review a critical part of the process, especially for losing trades. They detach their emotions and look at the data. Did I follow my plan? Yes or no? If the answer is yes, then it was a good trade, even if it lost money. They accepted a small, planned loss. That's a win for discipline. If the answer is no, they ask why. They identify the emotional trigger and create a plan to handle it better next time. They analyze the mistake not to punish themselves, but to improve their process. Do you see the pattern? The single biggest mental mistake that holds traders back is greed or fear in the way we usually think about them. It's the deep, subconscious need to be right. This one, desire, is the source of so many destructive behaviors. Moving stops, letting losers run, revenge trading, and avoiding trade reviews. We believe our success is defined by our win rate, by our ability to predict the market. So we fight reality. We bend our rules, and we damage our accounts, all in an effort to prove we are right. The profound shift that creates consistently profitable traders is when they stop trying to be right and start focusing on executing well. Your job is not to be a market wizard. Your job is to be the disciplined manager of your own trading system. Success isn't one perfect trade. It's 1,000 trades, executed with discipline, where you follow your rules, whether the trade wins or loses. The next time you're in a trade and feel that urge to move your stop, to force the trade to be a winner, I want you to pause. Take a breath. Remind yourself that your self-worth is not tied to this one outcome. You are not your last trade. Being wrong is not a character flaw. It's a data point. Let the stop loss do its job. Follow your plan. Choose long-term consistency over the short-term satisfaction of your ego. That is the path of a professional. That is how you build a lasting, mindful trading career. Thanks for watching.